Thank you. All right, so we're shorting here, and we're supposed to be keeping an eye on Brent. The dollar's going down, though. That's going to be supportive of oil, so maybe we won't watch that one. I don't really care about the indexes. BZ is Brent. So we want to make sure Brent is below 60. Otherwise, we should stop out of this trade. And also, we kind of have a stop at, I guess from an auditory standpoint, I should set the stop. Do I want to do that? No, because I have conviction in my position, so I'm going to let it ride without the stop, because I really think oil should be selling off significantly from here. And in fact, why don't we talk about that? So the EIA released their 1030 report, which is a short report. Dun, 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 dun. Control F, EIA. So okay, first of all, sorry, let's do this in order. API. So the API report showed a 9.3 million barrel draw in oil. That's their headline. But then it was offset by a 4.8 million build in gasoline and a 2.5 million build in distillate. So that's 7.3. So there's net 2 million draw in oil. Okay, keep that in mind. Net 2 million draw, 9.3 million headline. So then the EIA came out, and the EIA only showed a 1.3 million barrel draw. That's compared to 9 point whatever, right? I already forgot. And then a 4.7 million build in gasoline and a 1.7 million build in distillates. So that's net. This is getting to be math now. So it's minus 1.3 plus 4.8 plus 1.7, net 5.2. So there was a 2 million barrel draw in the API, and that helped the futures go up overnight for oil. This is overnight. Okay, that's what popped the futures. And the reality, though, is nothing like that. It's exactly the opposite. It's a terrible, huge build for oil. All right, but the dollar, which is dropping at this very moment, is supporting oil. So the move up in oil is an illusion caused by the dollar at the moment. That's why I don't want to set a stop. So that's how we're playing it now, and that's what I said here. As Brent is 59.91, I'd stay short CL at 56.07 with a stop at 56.16. And then once it goes under 56, which would cause your average to be 56.03, drop the stop to 56.10, or obviously if Brent goes over 60, we have the same problem. And so that's what we're doing. We're expecting to go back to 55, where it was just like yesterday, right? I would think it was yesterday. I don't like to play, I don't like that. We hardly ever do this. That's what you have to realize. We don't make these calls very often. So it's not like we're playing the oil markets constantly, but when something is obviously lining up a certain way, then we like to play it. So yesterday we tested 55 right there. See that bounce? And by the way, had I not been asleep at the wheel, we should have played for that bounce, because of course you're going to bounce off 55 after dropping from 60. It's the 5% rule, right? You go from 60 to 55 is $5, so your bounces are $1. So this is the weak bounce line. 56 is a weak bounce line. 57 is a strong bounce line. Very simple. That's how you use the 5% rule. So we made it halfway to the strong bounce, then it turned back around, and now we got some bad news. So it's very, very likely we're going to come back down to at least 55.50, maybe 55, and that's going to be good for $500 a contract or 1,000 at 55. And when we get to 55, we should play for bounce again, because it's probably not going to fall below 55, no matter how crappy this oil report is. But let's see. So now we look for the petroleum status report. So that first one was off this 1030 report here. Let me show you. This is a 1030 report. That was the basis of the thing we just looked at, right? So that's all you get at 1030. And then at 1 o'clock, though, now you get some information. Now we got a report. See, because we get all this stuff. Okay. So it's the same crap. I mean, it says the same thing. It says oil decreased by 1.3, blah, blah, blah. This part's pretty much the same. This is where you get to look and see what the meat and potatoes is. One thing I always look at is how much oil are we exporting? And we're exporting 5.5 million barrels a day. That is 5.5 times 7, 38.5 million barrels a week. How much oil do we produce in America? We produce 20 million barrels a day. So we're exporting, we're exporting, let's make it simple, we're exporting 2 days. 28.5% of the oil that we produce is being exported out of the country. That's freaking incredible. You know, and that's why everything you read is like, everything you see about U.S. oil consumption is a lie, because we are the largest exporter of refined oil products in the world. We supply all of the Americas with refined oil. And especially South and Central America, they just don't have the refining capacity we do. So we are the de facto supplier for all these people, and that makes U.S. consumption look way higher than it is. It also makes U.S. dependence on foreign oil look way higher than it is, because all this rhetoric about our dependence on foreign oil is bullshit, because we're shipping 5 million out. We only import 2.4 million barrels a day of oil, and so net we're sending 3.1 million out of the country. But the net isn't the point here, because here's our total product supply, 20 million a day. So 5.5 million a day of that is being exported. That's insane. So, and even so, even doing that, even exporting, what do we say, 38 million, even exporting 40 million barrels a week, essentially, of oil. Okay, so think about this. Where'd my calculator go? I closed it, I guess. Even exporting 40 million barrels a week, so 40 million barrels times 52 weeks, even exporting 2 billion gallons of oil, the Strategic Petroleum Reserve since last year has gone from 1626 to 1687. We've actually gained 60 million barrels of oil in the Strategic Petroleum Reserve, even though we exported 2 billion gallons. I mean, that is the most bonkers statistic on the planet. And if we say that's like times $70 a barrel, $145 billion worth of oil exports. We did, before Trump before his first term, we had rules against exporting our oil in large quantities, because it was supposed to be for America. It was American oil for America, and we had rules against exporting too much of it. And also we had to maintain a higher strategic reserve than we have now. He turned us into an exporting country, essentially, and you know, which is fine. I mean, obviously it's money that comes in, it's taxes that come in and all that, but you have to realize we're depleting our own oil by whatever the number was, 40 times 52, 2 billion barrels. So we're depleting our oil reserves by 2 billion barrels, and we don't have 1 trillion barrels worth of oil reserves. We're depleting them All right, again, I'm sorry I have that thing where I can't just make up statistics. How much, how much oil reserves are left in the US? I mean, that can't be right, obviously. We only have 46 billion barrels of oil as of 2025. Proved reserves decreased by 3.9% from 48 to 46 billion barrels. Oh, maybe that is right. I guess so. Year over year from 2022. All right. Well, figure that's probably right then. We only have 46 billion barrels of oil and we're exporting 2 billion of them. And that's exporting. We're of course using our own oil too. We're using 20 million barrels a day. 20 times 365, 7.3 billion barrels. So what we're doing is we are depleting our reserves, of which we only have 46 billion barrels left, by 7 billion barrels. And that means we have 6 years, 7 years until we run out of oil. And by the way, running out of oil, you're not going to get every single barrel and scrape every single reserve off the bottom. So, let's say if at best you're going to have 80, you're going to be able to use 80% of that, maybe 60%. But let's say 80%. 80% of that is 35. Now let's do them. All right. You know what it is when I'm tired? My brain is just like real anal retentive. So let's say we have 46 times 0.8. 36. Okay, see, and I'm right too. That's what annoys me because I was like, I did the math correctly, but it just couldn't be definitive about it. Anyway, so we've got 36 billion barrels left of easy to get to oil. That's 80. That's assuming we get 80% of our reserves out of the ground. That's at 7 billion barrels a year. That's not a lot of time. Because like 6 times 7 is 42, 35. So it's 5, basically 5 years. We have 5 years until we've used up all the oil. And Trump has canceled our electrification demand. So what that's going to mean is that we will become 100% dependent on imported oil, which is a strategic and economic nightmare, in 5 years. Okay, that's freaking insane. It's not bad foreign policy. It's murder. It's suicide foreign policy, or policy, whatever the hell you want to call it. This drill baby drill thing is for Russia, and of course, as you know, a huge amount of the social media and the stuff you get on Twitter and whatever originates in Russia and China. It's like we're constantly besieged by false flag information that poses as conservative groups and things like that, and conservative think tanks and things like that, and actually is disinformation by China and Russia, because Russia would love us to be 100% dependent on exports, on imported oil. Not only that, though, but think of like the strategic military disadvantage we have if we no longer have a domestic oil supply. Okay, you can't deny that that's our policy. We only have 46 billion barrels in reserves, and if you look at 80% of it, it's down to 36 billion barrels of reserves, and we're using 7 billion barrels a year, and we're exporting 2 billion a year. We don't even need to be using it. We could be doing 5 billion barrels a year, and at the same time, Trump is saying no more electric cars, no more windmills, not even solar. They don't even want solar. They're not subsidizing it anymore. Everything should be using gas or coal. And eliminate the mileage standard. That's the other thing he's doing, is eliminating the mileage standard from cars so that we don't save gas either. This is crazy stuff, folks. It's not crazy stuff. It's anti-American. That's what anti-American is. Not planning for your future, not looking ahead 5 years. And I'm sorry, I say not looking ahead 5 years, pretending you're not looking ahead 5 years, because there's no possible way anybody can look at this number and not and anybody could look at the number, the amount of oil we use every day, and say, oh, I don't see how that could be a problem. It's a giant red flashing light problem that we have here, and nobody's doing anything about it, where they're actively doing the opposite. They're saying, let's drill more oil, let's get it all out of the ground as fast as possible, so the US is completely at the mercy of petroleum states. And petroleum states who do what? Who give Trump billions of dollars. That's those petroleum states, the ones that have their hand on the orb with him. Those are the petroleum states. The guy he sat with in the Oval Office and told the reporters, well, he wasn't that reporter he chopped up wasn't such a nice guy anyway. Let's not talk about him. It's in play. So whoa. Okay. So anyway, I'm done ranting about that. All right, so that's where the oil is. That's the scam. Please like and forward to any rational people you know, because this is beyond insane. And despite all this bullshit, we're still using less gasoline than we used, even though we're exporting so much of it. We're still using less gasoline than we used last year, or creating less gasoline. The gasoline reserves are up from last year. All of the products, the price we pay for gasoline is lower. We're paying less money for gasoline because again, if we weren't exporting it, we'd be swimming in it. Our strategic reserves are 1.67. What is our strategic petroleum reserve capacity? Oh, that's a weird thing. 714. Well, that's not really telling us what we want to know, because they're talking about just the oil, but still. So basically, our capacity, if we fill that up, would be 714. So we could put 300 million more barrels of oil in reserve. It's hard to say what gasoline and distillate could be if we filled it up, because this isn't really reserve. It's more like commercial tankers and things like that. Whereas the oil is what the strategic petroleum reserve is. So it's pretty empty, and we could put 300 million barrels in it, but instead we're shipping them overseas, which again is insane. And I didn't plan to talk about this at all, but I mean, it's so obviously crazy what we're doing. And it's not funny crazy. I mean, it's going to get 20% worse every year for the next 5 years until we're fucked. So I don't know what you want to call that, but crazy is probably not the word. Oh, and there goes my bottle cap. That's bad. Okay, my bottle cap just went flying under my desk. All right, so done with that topic. See if anybody has any questions about my first rant. Oh, Cody says, I'm catching up on my portfolio, so sorry if you answered this already, but have you released the LTPT updates? And Cody, the answer is no. I just said that in member chat. I have not done it because it's been a crazy week. I hopefully we'll have some of it started tomorrow and certainly by Friday, but no, this is a bad week for getting things done. So if we're lucky, I'll have good progress on the long-term portfolio tomorrow, and then we'll certainly have it done by Friday, because that's kind of important to get it done by Friday with the options expiring. The reason it's extra hard now is because now we have our new criteria for next year. So there's every single position has to be examined from the standpoint of not whether we're going to adjust it or not, but whether we even want it in our mix in 2026. Because you know what we've done. What a great transition. Thank you, Corey, Cody, whatever. Hang on, I'm going to get his name right. Cody, right, Cody. So thanks, Cody. Because in the chat room, not very long ago, what is this? So in the chat room, we have defined, see here, members only, we had our top 20 trades for the year. And earlier on, we had updated our watch list. Like 2 weeks ago, we updated our watch list. You can probably find all this stuff under portfolio reviews if we have such a thing. Oh, there they are, portfolio reviews. Aha, see how organized? So here's our top 20 trade ideas. I should put the trade of the year up in here too. There's our top 20 trade ideas. Here's the watch list. Here is the first part of the watch list, 2 sections. And here's the November portfolio review. So when in doubt, go to the members only section and click on the portfolio reviews and you'll find all kinds of amazing things. And yesterday, not yesterday. Oh, silly me. Oh, well, this is good, isn't it? Oh, yeah, okay, great. So save you a lot of reading. Here's our macro backdrop. Okay, so this is summarizing what we did yesterday. And I said, well, in yesterday's post. So in yesterday's post, or Monday's post, yes, Wednesday. So Monday's post, we really laid everything out. I mean, in theory, I shouldn't have to come back and talk to anybody about anything until 6 months from now, because you cannot possibly have laid out a more of a strategy plan. But Bodie and I, Bodie and I talked about this, and I let Bodie write it because he can write it as well as I can. He can write a lot faster, so I let him talk. I let him sum everything up. But what's the mindset behind the watch list? What are we looking for? And extensive stuff here. Can this business survive an ugly 2026? Does the current price give a real margin of safety if it's not 2021 again? Does it add something distinctive, cash flow diversification, asymmetric upside? In other words, in the mix of our portfolio, why are we picking this stock? Why are we going to add this thing? How is it going to help us be balanced and safe and productive next year? All that stuff matters. This is something Bodie and I have been working on lately, as we call it the 4th law of robotics, because there are 3 laws of robotics from Isaac Asimov, and this one is basically how you must. I said whenever you say something, I said make sure you think about whether or not you would be embarrassed to have it read back to you in 5 years. So in other words, don't make a statement that this is definitely going to do that, or that's definitely going to do this, or this is inevitable. I said think like an analyst and say to yourself, how sure am I about this? Am I overstating something? Am I understating something? Am I not pointing out the potential flaws in my strategy? And so if you think about that every time before you say something, which AIs tend to say something first and don't think about those things, then you'll do a lot better as an analyst. Then we've got macro environment, yeah. And then we're looking at the macro micro lens, which is on that thing I just showed you, so we'll get back to that after. But then here we had the final 24 picks, and these are the stocks that we like the most going into next year. And here's the economic and market setup. We expect slowing growth and higher chance of a recession. Stagflation is absolutely embedded into the picture. The consumers are very fragile. We all know that. The AI productivity bet may go bad, and there's a lot of problems with people implementing AI solutions. It doesn't do what people think it's going to do. But not only that, but all these AIs are they need power, they need the infrastructure, and so on and so forth. So there's a constraint on building AI and solving these problems because the infrastructure takes time to build. The infrastructure is a physical thing. You have to build a center, you have to build a physical building, you have to find a way to cool it, you have to find a way to power it, you have to add power capacity to power it, you have to then get the chips, and then you have to have the people to staff it and the programming and so on and so forth. It's a big thing. It's years. It's not months. So people are projecting this ridiculous amount of growth next year, and the bottleneck is going to be in the infrastructure. It's not the demand, it's the infrastructure is going to bottleneck this whole thing. So even if you're right about, in fact, the more right you are about the growth of AI, the more of a problem the underlying infrastructure is going to be. And also, the more you spend on infrastructure anticipating this tremendous AI growth, what if you're wrong? And especially when you consider the concept, if you all know Moore's law says every certain amount of years, you will get a 10 times growth in computing power at 1/10 the price. So the cost will go down 90% and the power will go up 1,000%. That's what they're saying. That's what Moore's law is. And Moore's law has held true for decades. You know, Moore was the founder of Intel. And it was his observation of their own chips and capacity on how that went. So what is the time length for Moore's law? Every 2 years. Oh, I'm sorry. The numbers on the transistor double every 2 years, but if you go 5 years, it's like 10 times or something, or a certain amount of years. He initially said annually and then adjusted it. While it's been an industry driver, many experts can say it's going to hit its limit in 2036, which is still a while, evolving towards new 3D chips. So if we say they double every 2 years, though, you have to think about this. So and the price goes down in half. All right, let's say 2 years and then the price goes in half. Maybe I'm thinking of 10 years or something, or less. It's less than 10 years, but so if the number of transistors doubles every 2 years, the computing power doubles every 2 years, and the price drops in half, that's great for expansion. But think about this: you're building infrastructure capacity for 1,000, right? But next year, not next year, in 2 years, you're only going to need 500, and 2 years from that, you're only going to need 250. So in other words, for the same amount of computing capacity, you would need a quarter of the space in 4 years. And now the cost will go down. That's good for the chips. But what about the guys who are building the infrastructure and spending money on all that power and all that capacity? What if the chips advance to the point where they don't need it? And I'll say case in point, mobile phone. If you remember your first mobile phone in 1985, so what's that, 40 years ago? So 40 years ago, a mobile phone was a brick that if you held it to your head, your ears would get hot and start sweating. Okay, you got anybody old enough to remember that? Like, it was a hot thing that consumed a huge amount of power, et cetera, and it only did the one thing, which was make a phone call. Now we're walking around with what is essentially, well, not even essentially. I mean, it's basically what a laptop was 15 years ago. So in 19 whatever the hell year 19. I'm so old. 2025. So in 2010, a laptop computer, also with hot batteries that and needed fans and cooling and so on and so forth, that's now your iPhone. Got all that capacity. So what's going to be, so again, so in other words, if you built a storage facility to house the power of 1,000 laptops, in 15 years, which is long, but in 15 years, you only need to house 1,000 iPhones. And you only need the electricity of 1,000 iPhones. And the problem is that when you scale this infrastructure up, these are based on 20-year paybacks. They can't get, they're outlaying billions and billions, hundreds of billions of dollars to build nuclear power plants. These have 30-year payback periods. So the plants they're building have 20 to 30-year payback periods, and the buildings obviously 20-year plus payback periods as well. So you're investing all this money in things that may never get used because the technology will advance. Or what if quantum computer comes along and changes the whole thing, so all this stuff is not needed anymore? And that's why you see, and so the point is, nobody's that stupid. Yes, everybody's that stupid. That's how .com happened. Everybody is that stupid. But some people are not that stupid. Let's put it that way. Some people are not that stupid. And they realize this, and therefore what's going to happen is venture capitalists are going to realize that maybe we shouldn't be investing all this money in data centers, but that's a problem, because if they don't invest in the data centers, and by data centers I mean the infrastructure and the power and everything else, if they don't invest in that infrastructure, and that's the picks and shovels thing, it's that picks and shovels thing that everybody keeps talking about. If the venture capitalists say, wait a minute, you're not guaranteeing your return on the picks and shovels. You're saying, oh, picks and shovels, which, by the way, is our investing theme for next year. So let's keep that in mind. But if the venture capitalists at some point are going to look at all this picks and shovel spending and say, wait a minute, you're not guaranteeing me you're going to be there for 20 years from now, occupying my spaces. This might not go the way I thought it would go. And again, if you go back to, if you go back 30 years, to be real, let's go back 20 years to 2005 and think about what your computer looked like in 2005. Now I know this because my kids were born 2000 and 2003, and so in 2005 they had an Apple. Was it an iMac? Yeah. So that was 2005. And they had that, and it was great because this was a CD player, so they could watch all their shows. They had a whole bunch of discs, and it was easy enough for them to use that they could pop a disc in and watch anything they wanted on the computer. And plus use it as a computer, in addition. But it's just like a player for music. It could play music, it could play CDs, DVDs, whatever. It was fantastic. It was like such a great gift for my kids. And I remember Jackie. I mean, she must have been like 2 years old, and she knew, because that's when we got it, when Maddie was maybe 4 and Jackie was 2, and Jackie knew how to change the disc. It was great. And anyway, so anyway, size-wise, so think about that, and now think about your iPhone is this big. And your iPhone is 1,000,000% superior to this thing in computing power and so on and so forth, technology, all the things it can do. This can't make phone calls. This didn't have Wi-Fi. Wi-Fi didn't exist back then. So if you think about, well, I'm sorry, Wi-Fi probably did exist back then. No, maybe it didn't. Oh, I don't. I can't remember at this point, but I don't think so. I don't think we had Wi-Fi, or if we did, it was just starting. But yeah, you're talking about not even, this is not 1/10, this is 1/30th, 1/50th the size with more computing power. So that's how violently things change in 20 years. Screens aren't even like this anymore. That's a screen. A screen is now this very thin thing. You know this. A screen is now this very thin thing. In fact, the thing I'm giving the webinar on now is just a screen. It's an HP. It's got a screen and it's got a, well, none of these are going to have that. It's got a screen, and the thing the size of the keyboard under the screen is the actual computer. It's a self-contained unit. This is a, what is this? Oh, it's an Envy. It's a, I think it's an HP Envy, or yeah, either Dell or HP Envy computer. And I love it. It's a great, great piece of equipment. Hang on. Yeah. Well, I don't see. Oh, there it is. That's me. That's what I'm doing the webinar. I love this thing. It's fast and it makes a statement, and it has Bang & Olufsen speakers. So that is exactly my computer. So this is my backup computer. That's why I bought it, because just in case anything goes wrong, my main setup, I have this thing. And then as time went on, I started to use it for the webinars. But yeah, this does a fantastic job. Very powerful. So again, you know, this thing in this space compared to what you know, it'd be, it's probably 1/3 the size of an iMac, and really you don't need the screen. So the computing part is just this little box here. You know, screens aren't important for a processing center. So that's how fast things change. So now you have to think about this from the point of view of the infrastructure builders, especially the guys financing the infrastructure. And they're saying, oh, we need to borrow $40 billion to do this nuclear power plant with 5 processing centers and blah, blah, blah. And the bank's like, wait a minute, I'm going to lend you this money, and your payback plan is to give me back like 4% or 3% of the money I lend you every year for the next 30 years. But what happens if something changes? Then what's your plan? What happens if they start building data centers in space, which sounds kind of kooky, but it's very viable, because the space solves the cooling problem, right? Space solves an electricity problem because you get direct solar rays, and you can power your data center with the solar arrays, while also blocking the sun from the Earth. So we might even be able to stop global warming with this plan. So you put data centers in space. You have arrays of solar arrays that catch the sun. Trump won't like it if you have solar arrays, but it's kind of hard to get the oil up there or the coal. And then you beam the data back to Earth like Starlink does, basically. It's the same kind of thing. But the main point is, it's not the data. See, in the data centers, it's the computing power that matters. The data they send back, these AIs, they send back not that much data compared to what they're crunching internally. So they don't need a wide beam to send back the data or to take it. Because what do? You say to the AI, write a report on Dairy Queen, and it comes back after crunching all the numbers and looking at all the things and checking all the information. It comes back with a 10-page report on Dairy Queen. So that's just a little bit of text back and forth, and you're done. The real work is done at the data center level. The data centers need energy, and they need to get rid of their heat. And space is incredibly good at doing that, although who knows? I mean, heat pollution in space could become a thing. But at the moment, we don't know that there's a problem with venting our heat into space. I mean, frankly, that's what our planet's doing right now. So again, you don't know what will change. It may become practical for us to do that in the nearer future than people think. And as soon as that happens, then every earthbound data center will be worthless. So now the trick is, how does OpenAI get someone else, not them? They don't want to buy a data center. They want to be a customer of a data center. They need to convince data centers to build themselves. So the question is, how long of a contract are they willing to sign? Because don't forget, if OpenAI encourages the building of data centers by signing 10-year contracts, and even that might not be enough, but if they sign a 10-year contract for a data center, and somebody builds a data center, and then 5 years from now, we're launching data centers into space, then OpenAI is not going to be competitive on a cost basis with the newer companies who use the space data centers. So I know that sounds like a lot of stuff, and it seems like, you know, insane, but it's realistic. You got to plan for these things when you're changing the world. When you're in this incredibly churning sort of environment, you got to look at all these things. Anyway, that's all under AI productivity. Then you've got the interest rates are high. That's another problem with building data centers and all these AI build outs, is that the rates are not coming down as fast as they wanted them to. You know, tariffs are obviously not going away at the moment, and we're waiting for the Supreme Court decision, maybe January. But, you know, so far they don't really say no to Trump very much, so we'll see what happens. The Fed policy chaos, and it's going to continue like this until May, when Powell gets replaced. We do not know. I'm sorry, it won't end in May, because no matter who you put in the Fed doesn't operate as a dictatorship. This is another thing Trump doesn't understand, because he operates like a dictator. The Fed doesn't operate as a dictatorship. If Powell is outvoted, he would not be able to set policy. Policy has to be set by the votes on the Fed board. There's 18 members, and Powell has one vote just like anybody else. They have to forge a consensus to set policy. So appointing a Fed chair that nobody respects and nobody likes isn't going to fix anything for Trump. He won't be able to set policy. He won't be able to force it. It's like that Mirren, that idiot he appointed, who says every meeting he's like, it should be down 5%, down half a point, down half a point. Nobody cares what he says. He's a Trump stooge on the Federal Reserve Board who says lower rates, lower rates, lower rates. That's all he does. That's his job. That's what Trump put him there for. And he's trying to do it well, but it doesn't sway anybody, because these are intelligent, hardcore economists. And not only that, they don't work for Trump, they work for the frickin' banks. So he's not going to get his way, and even in May he's going to not get his way. And frankly, in May he's going to lose his shit when he appoints somebody and it doesn't help. He's going to go crazy. So the Federal Reserve thing may not get better; it may actually get worse once Trump appoints a new guy, because he's going to freak out when he can't get his way on rates. And also, there's the background fact that Trump doesn't set. The Federal Reserve doesn't set rates. The bond market sets rates in the end. The Federal Reserve can guide rates and they can influence short-term rates, but in the end, as Greece learned back in 2008, whenever, in the end, the bond market tells you what the rates are. Your central bank can say whatever it wants, but the bond market says, no, we're not going to give you money at this level. So unless we stop borrowing money, and unless we pay back all of our debt, $40 trillion next year, unless we pay it all back, then we're at the mercy of the bond market. And they're going to tell us what they're willing to lend us money at. And they are not willing to lend us money at 3% or 2%. It's closer to 4%, basically, is what the price of money is. The price of money for a country that's $40 trillion in debt and needs to borrow $2 trillion more next year, next fiscal year, because this fiscal year ends in September. Anyway. So fiscal gravity, debt overhang, I just said that. So basically, this is how we summed it up. Economic and market setup. This is, I seriously, this should be like, you should make a poster of this and put it in your office. slowing growth, high risk. I just said a list. Fragile consumer. It just visualizes everything I just said, and it gives you an idea of what we're doing. So now we have to measure all of our stocks against this benchmark. And so, you know, in these posts, there's a lot of talk about what our methodology is, how we look at things. Every trade we're talking about, every time I review a different trade, we're talking about, are we keeping them? Why are we keeping them? Why aren't we keeping them? What's concerning us? That's all in there. And that's why the long-term portfolio is going to take me like 100 years to do in 2 days, because it's a huge amount of work. Every single trade has to be looked at from scratch, saying, does this fit into a profile for 2026 that we want to be in this trade, that this is our strategy for 2026? Does it fit our strategy? Does it fit the macroeconomic profile? And does it balance the overall portfolio so that we're strong on all sides? That's a big thing about diversification, is if you're not diversified and you don't have balance, then you're just constantly like rocking back and forth and not knowing where you're going to be. But if you do what we do, which is be very diversified, have lots of different positions, sell tons of premium, you just generally, there's so many ways to win and so few ways to lose that we generally muddle through almost any kind of economic situation. And we just had a wonderful drop of 5%, which we love because it gave us a chance to test all of our hedges and all of our positions, and they came through very well. So hopefully we don't have to cut too many things, but we certainly are going to be adding things after we see the shape that we're dealing with. You know, it's literally like maintaining hedges. It's like you've got to, you know, you make some big cuts and whatever, and a certain shape because that's the way you wanted it to go. But then once you've done a certain amount, you've got to start getting out the small clippers and just making all those fine adjustments in order to make it actually nice. There's a difference between, as anybody who's hired a gardener knows, there's a big difference between just getting it, you know, but there's a big difference from like just doing general weeding and yard work as opposed to like manicuring a lawn. That's a whole different concept. And that's what we're doing. We have to work with a lot of stuff, and we've got a lot of weeds to pull, and we got a lot of new plants to plant. So, oh, speaking of which, how's oil doing? Yay. 130 bucks. Very nice. All right. We'll see how that goes. $150. I love the markets. So much fun. All right. Any questions? So Opti says PPL 2028 short options are not filling at all, not even close to the suggested price in the top 4 trades. Says they're not liquid. Just finished the vet visit. Oh, that's Maddie. Hi, Maddie. All right. So PPL. All right. Let's see. What do we say we want to do for PPL? That's a good thing to talk about. We're skipping ahead a bit, but we'll do it. Dun, 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 dun. Here it is. So the 2028 short option. So he's talking about the short $40 calls. And he says they're not filling. So let's take a look. We've got PPL 2028. What were we trying to fill? The $40 calls. The $40 calls have a really wide spread. They're 10 cents and $3.50. We wanted to sell them for 250. So first of all, Opti notes. So first of all, you don't have a bid in because you're not asking 250, right? Am I crazy? Because so in other words, we said, or 270, sorry, 270. So we said sell them for 270, and obviously you don't have a sale in for 270, or they would say 270 here and not 350, right? So you're not even asking for 270. So it's certainly not going to fill if you don't have an ask in. And I mean, that's just a fact. There it is. There's no ask. Those are the boards. So if 570 for the longs, so you know, now if the longs were the 30s, 570. Oh, I see. You're offering 570. The last was 660. I would not pay that. So don't fill the trade. That's my answer, is don't fill it if you can't get the price. By the way, it doesn't matter what the numbers are. What matters is the spread. And we said, so what we were looking for is we're looking for a spread of $3. I don't care if it's $10 and $7, it's $3. That's what we're looking for. So the question is, can you fill the spread at $7? It is incredibly thinly traded, and there's apparently no market yet. In fact, I'm not even sure. I mean, doesn't look like much activity of any of these. They're all pretty wide. If you took the 30s here, they're 586, and if you take the 40s, they are not much. They're 75 cents. So that's a $5 spread for $10. I mean, $10 spread for $5. I don't want that. So I guess I would pay $4 for the spread because it is a $10 spread, but I don't see any reason to rush it. It's just place your offer at the prices you want, and if it fills, it fills. If it doesn't fill, it doesn't fill. That's all. I mean, you've given it what, 24 hours? I mean, we take weeks to make these fills sometimes. Yeah, you say, I see you're saying it's on Interactive Brokers, but it's not reflecting. It's weird. Why would it not have your price? That doesn't make any sense. I understand the offer. In other words, the bid 6 is higher than your bid. So yeah, of course, that's not going to show up. But this one doesn't make any sense. If you offered 270 for the shorts, there should be a 270 there. So anyway, but I wouldn't even worry about it. I would just basically be, you know, I mean, I would actually put it in this case, since it's so thinly traded though, I would put in for a $3 spread or even a $4 spread. I'd say I would put in for a $4 spread on half and see if it even fills. So in other words, we're saying, so, you know, this spread has such a low net. It's not, so what we're saying is 570, 270. I would ask for 5 at $4 and see if it fills. That's a small thing. So 5 and 5 at $4. If you can get, you know, so in other words, will they fill? If they fill, you've got something to start with. You at least know a basis for what's going to fill. You know what the strikes are, and then you can work around that and see if you can work it down in chunks of 5. That's the best way to play it. But it is thinly traded, and all you can do is be patient. If it takes a long time, it takes a long time. Also, though, you got to look at the actual chart, and you look at PPL. And you say, what's it doing? Well, so it's heading up. We had good earnings. It sold off for God knows what reason. They just paid their dividend, and that dividend was 27 cents, not a big deal. So they paid a 27-cent dividend. That's when it hit the bottom, was people got paid their dividends, and everybody who wanted to get out got out. Now people are buying it back up. Okay, so we think it's going higher, so I'd be more inclined to take the long positions now, and, you know, or start taking, you know, if I'm going to err, I'm going to err on the side of being long, and then wait for the fills on the short calls. That's all. And when I say wait, I mean, look, it took December 1st, so it took December 1st to the 10th, so it took 10 days to drop 37, more than 10%. And so yesterday I called it, and maybe that's why people are buying it now, who knows, but it started inching up now. Now, if we expect it to recover 5%, it'll probably take 10 days to go up 5%. So to get to 36 is going to take probably all of next weekend. It's the holidays. It's thin trading always around the holidays. So, you know, you may not be able to fill this thing until next year. So what? It's not life and death to own these things. You get the ones, and frankly, as a trading philosophy, we talked about this with the members the other day, yesterday maybe. As a trading philosophy, you should never buy the things that you can't get cheaply. If you can't get your price, don't buy it. Move on. There'll be another trade next week. There'll be more ideas all the time. The whole point of having a watch list is to say, oh, it hit a price I really want to buy it for. In fact, look what this did. If we'd been, if we'd been paying attention before I just put it on the list, look what it did. It showed a very, very clear bottom here, a very clear, well-supported bottom several times this year. This is huge support. It could not crack below that line, and then it popped back up to what? To the well-rejected top. So we have a well-rejected top and a well-supported bottom. That's ideal for deciding when you're going to buy, sell, when you're going to sell short calls and when you're going to buy longs and so on and so forth. There's your channel. Your channel's 33 to 37. It's a 10% channel. So at the bottom of the channel, you want to do your buying. At the top of the channel, you want to do your selling. You should do better than what I said, not worse. And if you can't get your fills, don't do it. And like I said, you scale in. You don't just jump on 25 longs right now. You buy 10 longs because it's at the bottom of the channel. And then you say, I want to sell short calls when it goes up here. And you've got to have your price, and then you see here's a resistance line, so it might stop here, and then you have to say, how much do I want to risk? How much do I want to risk it getting rejected over here? But you're going to probably get your price over here. It's going to be hard not to on the short calls. So here you should be selling puts and buying long calls, and when you get up this way, you start selling short calls and selling selling short calls. Sorry, you're selling short calls. So this is short puts and long calls, and here's short calls. That's it. That's one of the things we look at when we're picking a stock, is saying, do we have an identifiable channel to trade in? Because that makes it so much easier to make money during the year. It's like our old butterfly portfolio strategy, but now we're doing it in the long-term portfolio, because in uncertain times, that's the way you want to play things. So yeah, definitely ask these questions in chat though, because if you do it in chat, we can do a whole little thing with it with Warren and everything. So it's fun. We can, because Warren is right now building a trading book it's going to be an AI trading book. That's the idea of what we're heading towards. Is he's amassing the knowledge to create a trading book that's live. So when you want to learn something, he will explain it and he will show it, and you can ask him over and over, and he never gets tired of answering the questions, and you can apply it to each specific stock you're trading at. He can look at it and help guide you and buy. It's going to be phenomenal. It's going to be an incredible, incredible product. So I love it when people ask questions in chat now, because I get, we put Warren on it and we build up more examples for the book. Okay, so where are we? Oh yeah, right. So yesterday, and again, there, obviously we talked about this. There were 100-something stocks in the watch list. We knocked them down to 20 stocks in Monday's post. So it's all right here. So on Monday's post, we knocked it down to 20, and here we knocked it down to 10, or maybe I thought maybe Monday we knocked it down to 10. I don't even remember anymore. This whole thing's a blur to me. And then yesterday oh yes, I'm sorry. So yes, so Monday we also knocked it down to 10 in the member chat. We hit the final 10. And it's useful because educationally, it's very important, because what did we do? We explained why everyone went from the top 20 out. So the ones we removed from the top 20, they were more than 20, but the ones we removed from the top 20, the 10 that we took out, we said, this is going out because of this. Here's the problem with this one. Here's the problem with that one. These are 20 amazing stocks that I would happily put in our portfolios at any time, but that doesn't mean they're perfect. You know, our final 4 should be basically perfect stocks, and our top trade, which ends up being Pfizer, should be spoiler in case you didn't know that, but our top trade Pfizer, we can't imagine. This is me and Bodie and Warren and Sinan, who is the smartest one we have, and Anya. We all talked about this, and we can't even think of a way that Pfizer is going to be below 25 in 2 years. So therefore, if we buy it for 25 now, if we start putting our spreads together now at 25, then the short put and call sales will make our 300% by themselves. Just selling the puts and calls is going to drop 300% into our thing. If the stock goes up the way we structure the trade, that's going to make 1,000% as well. So if all goes well, this spread could make 2,000% on the cash, which is nothing. It's 600. I think it was a credit. So if all goes well, the thing's going to return 20 times the credit that we're starting with, and we don't see why it won't. We can't find a good reason to say this won't happen, and that's even including the ludicrousy of Trump's drug policies and things, and the Trump RX, which is so far a complete joke. Anyhow, so getting back to the Money Talk portfolio, let's just talk about quickly what we did. So here's T. Oh, this is gonna suck. I always do this. There's no good way to do this. All right, let me think. If I do that, how about this? Okay. Oh, that's what I meant to do. I'm like, oh no. And I'm like, oh wait, that's what I wanted. So now we can kind of sort of I want to be able to look at them at the same time. All right, that seems to be okay. All right, so here we go. Yeah, that's much better. All right. So why can't I see? That sucks. All right, anyway, there's 98 bucks left here. Oh, we bought them back for 53, so we already did a good job. We sold the puts. They're January 20. Obviously, I don't believe in any way, shape, or form that it's going to get that low. But I said, why risk it? There's no sense in risking it for $53. So we just buy it back and say, fine, boom. Okay? There's no reason to ride it out. There's 20 days. I'm sorry, 30 days. There's 30 days left in which a catastrophe could happen. And why? We already made 3,000 whatever dollars. And we have we had $50 left. So what's the point of keeping it open? It doesn't make any sense. I know it's incredibly unlikely, but the problem is it's not incredibly unlikely because of New Year's and the holidays and starting next year and the healthcare fiasco that's going to happen because everybody's going to see these shocking increases in their bills, and millions of people are going to lose their coverage unless Congress does something in the next week. I mean, not even a week. I mean, it's Christmas. They're going home, right? Oh my God, what a disaster. Okay, anyway, so that's going to happen. So AMAT, we're already up $9,000 and we started with $7,000. So that's a 128% gain. It's a $35,000 spread. There's 116,000 left to gain. So we leave it. We don't have any reason to think AMAT's not going to do well. We think they're going to do great. ARC B. So here's ARC B, and we like that one, and we kept it, and we just adjusted it a little bit. Here's Barrick. We have that spread. And I said the only reason that Barrick is now trade of the year is it already had a huge run. We freaking love this company. I was banging the table on Barrick all last year, and now look at it. You know, so it's like up a good double. And we think gold's going higher, and they're going to make a fortune, and it's not baked into the stock yet. So we like them very much down here, and so we're just getting a little bit more aggressive. And it has $44,000. It still has an 875% upside potential, plus the short-term sales of premium. So are we going to keep it? Yeah, okay, that's a keeper. Barclays, also a ridiculously cheap bank. We love them. In fact, oh, I said we like them so much we bought them twice. We had this spread and it's done. So we've had this spread for a long time from 2024, because the money to our portfolio is our oldest portfolio. We've been running it for since I don't know, a couple of years. So unlike our other portfolios that we reset in June, the money to our portfolio was kept going. This spread did exactly what it obviously did much better than we thought, but we took a real conservative little spread on Barclays, and now we're just waiting for it to expire. Because why should I pay anything? Right? Because the net, did I say what the net is? Oh, wow. Wait, no, that doesn't make sense. Oh, no, that's the little one. Oh, I see. Okay, so I'll do the math. So currently, right, it's these numbers, 58,400 minus 52,400 minus minus 100. So right now it's $5,900 this spread. But what is it? It's a $2 spread, right? So it's $2 spread times 40. It's an $8,000 spread. What? Is that real? Wow. This spread has $2,100 left to gain at these prices, which probably aren't real. If you go to fill it, I doubt you'll get these prices, because it doesn't make any sense. Because how can you possibly have $2,100 left to gain on a $6,900 spread in a month? It expires in 40 days. In 30 days. See, the 30, that's when it expires. So, well, that's nice. I didn't even realize that. That's so it's from 400 days ago, and it's got 30 days left. So if you could fill at these prices, then you should, because you're going to make 30% in 30 days. I mean, that's just freaking insane. But what it means is, though, that these numbers are kind of unrealistic from a bid-ask perspective or something. I don't know. Let's take a look. Barclays. I mean, it's pretty interesting. I mean, really, we should all buy it. The January 10-12 spread. I mean, there's no rational reason. The other, the puts have nothing left, so it's all about this spread. The January 10s, oh, look how wide that is. That's why. So the January 10s, 1350, because nobody's trading them anymore. They're so deep in the money. So 1350, 1560, and the 12s are 11. Wow, $3 wide, 1160, 1460. See, so there's no point. You can't get those. You're not going to get a realistic price on this thing. Or I guess the most realistic price you'll get is it last was 1350 and the last is 1150, which is just about $2. All right, but there's no reason for us to do anything, because they're both going to get assigned out. They're going to get washed out of our account, and we're going to net the $2. So that's it. So what it really means, and this is a normal thing that happens, what it really means though is that when you look at your portfolio balance in any brokerage account, it's always going to give you a worse case than what's real. Generally, if you own something, it's going to show you the bid, not the ask, right? So this is what people are offering for it. And when you want to buy something, because you'd have to buy back these calls, it's showing the ask and not the bid. So it's showing you the worst of every option, which is great though, because what it means is when you're looking at your portfolio, your balance is generally quite a bit less than what it would be if you closed out your positions. So that's always a nice bonus when you close out your positions. But anyway, so the point is we have $2,100 coming to us when this thing closes. It's obviously not going to fall below that, so we definitely have $2,100 coming to us, which is a lot of money. And the higher one is still just basically right in progress as a long-term spread. And all we're doing is maintenance. The short January 22 calls at $2,900. Where are we? Oh, because it's a money talk portfolio and we only trade it once a quarter, I got to do my rolls now. I would not normally. I'd wait and see what happens, right? But we have to do our rolls because we aren't going to be here in January. I mean, we're not going to be on the show in January to make the adjustments. So I have to think in a quarterly basis for this portfolio. So even though it's only the 17th of us, even though even though we have a month left to make any decision on this thing, I can't make that decision in a month, so I have to make a decision now for March and April. That's the next time I'm likely to be on the show. I mean, it's Bloomberg. I can't make them put me on the show, so it's whenever they end up scheduling it. Even though yesterday Kim told me I'm their most requested guest. So that's kind of good. But I'm not going to throw my weight around. Anyway, so what do? All we're doing is housekeeping. That's what you should be doing. If your portfolio, see, that's the beauty of this. If your portfolio is well balanced, and if you are well hedged, and if you are diversified properly, then that's all you really end up doing on a regular basis is, and this is a quarterly basis, all we have to do is adjust our premium sales, adjust the short-term sales. So in this case, in October and November, we sold $1,500 worth of puts and calls. All right, and now it's net. It's not done yet, so it's kind of, it's not that they're not working; it's that they're not done yet. So it's kind of an unfair way to look at it. But we're getting $1,250, so it's $1,250 back. So we made $250 on this put and call sale. But that's not a bad thing because what's happening? Our bull call spread has gone $3,000 in the money. So we only are making $250 here. I'm sorry, we're not making $250. It's a loss. So I apologize. It's more than I thought. So we collected $1,500. We owe net $1,250. I'm sorry, we've lost net $1,250 on the $1,500. So all we're going to do though is roll it to the next set in March, and hope that we didn't. And I said that net's $50 back in our pocket. So we're selling more premium. We're selling more time. That's all we're selling is time, and we're giving ourselves 3 more months to win. Or 2 more months only. We're giving ourselves 2 more months of time that we sold, and we're giving ourselves another chance to get the target right. And if we don't, we're going to roll it again. But meanwhile, we're making our money up here. Spread is getting more and more in the money. In fact, it's almost 100% in the money. And again, that goes back to the math. There is $7,000, 119% left to gain. So I don't mind losing $1,250 if I'm coming into my $7,000. So yeah, I'm sorry to be confusing that. We sold $1,500 worth of premium, 1,000 here and 500 here. We owe back. We're not going to owe that. We owe back 27, so it's a $1,200 loss. But it's not, but all we do is we take that loss and now we're going to sell 2,800 more premium. So now we've sold 2,800 minus 12 is $1,600. So now we sold $1,600 worth of premium. So all that really happened is we failed to win in this quarter of premium. Now we have another chance to win in the next quarter. And if we don't win every quarter, so what? It's all bonus money. We don't count this. When we talk about our upside potential, we don't talk about the premium sales. That's all bonus money. I just said in Pfizer, though, that the bonus money is as much as the trade. We're going to make as much money selling premium in Pfizer as we not definitely make it, but we have the potential to make as much money in selling premium in Pfizer as we do on the trade. And the thing is, the only way we usually lose we can lose if it goes down, obviously the stock. We can lose on two ends because we sold the puts and we bought the long position. So we can get hit if the stock goes down a lot. But if the stock goes down a little, then the premiums win for us. And if the stock is even, if the stock is even, we're pretty much nailing it on the premiums and collecting the full value. And if the stock goes up a little, we're going to probably still win on the premiums. And if the stock goes up a lot, then our longs go in the money and we lose some money on the shorts. But so what? The stock made the money that we expect. And because we're using options for leverage on the longs, the amount of money they make is insane. And so we laugh at the little $1,200 we might lose along the way. That's how this works. So the only way we really lose money is if the stock goes down drastically and we oversold on the put side. That's when we can lose. And the way to cure that, by the way, is to set stops on your short puts. Make sure you know how much pain you're willing to tolerate. And that's never a problem if you only sell puts on stocks that you really, really want to own, that you have the ability to own, the capacity to own in your portfolio, that it fits in your portfolio, that it makes sense for you to own it for the long term. You know, Buffett says that about buying a stock. He says, never buy a stock that you won't be happy to own if the market closes tomorrow and doesn't reopen for 5 years. That's his criteria. And that's what Bodhi's talking about also when he talks about his rule, right? You need to be able to say 5 years from now that you're happy you bought that stock at that price in 2025. And if you can imagine a way that's likely to bite you in the ass, don't do it. You know, the key to you know, we have a lot of short puts in the short-term portfolio. We have none in the long-term portfolio. We're using the short-term portfolio for the short puts to generate income in case the market goes up. All the short puts become income. I mean, assuming the stock doesn't go against the market. And we can do that because each of the things that we sell in the short-term portfolio are stocks we want to buy in the long-term portfolio. So in other words, Oracle, for example, burned us in the short-term portfolio. We sent it to the long-term portfolio. So the long-term portfolio bought our losing position in the short-term portfolio. So it's all the same account, but I would like to, you know, to me, I imagine them as completely separate entities. But you know, it's a reporting thing that we do to have the two separate portfolios because it makes it much easier to talk about. But in the case of Oracle, so what we've done is we've reclassified it from the short-term portfolio. The loss is still there. It goes to the long-term portfolio as a losing position. And then the long-term portfolio makes the adjustments and ultimately will own Oracle if it keeps going down. But the long-term portfolio wants to own Oracle at that price. So the short-term portfolio is effectively absolved of the loss, and the long-term portfolio is getting the position at where it wanted to be, at the net of where it wanted to be. As long as you want to own the stocks and you're able to own the stocks, and you don't care if it goes down. I mean, obviously, if the story changes, that's a different thing. But not if all the parameters are the same. What happened to IVZ? See, look what we're doing. The old January puts are going worthless. We roll the short January 24 calls to April calls, and we sell 5 April puts. It's the same. These are minor little adjustments that we make all the time. Lockheed Martin. We already made 3,500 on the short puts and calls because we can't trade them in January at 3,900, and we're going to move them to these calls, and we're selling. So we're taking the 3,900 and buying it back early. Not that we weren't on target, not that we wouldn't collect that 3,900, but we're not going to be there to make an adjustment, and I'm sure not going to throw away the chance to sell this premium. So we're selling $11,000 in premium. So we're netting $7,000 more of premium sales by rolling it out 2 months. That's all we're doing. That's fantastic. By the way, fantastic for a new trade. What a great money-making trade that is. That's Lockheed Martin over here. Notice the little teeny tiny trade too. It's like only 2 of these, 5 of these, 4 of these, 2 of these. You know, we're not going crazy here because it's an expensive stock, and we don't want to have too much premium, too much margin. Sorry, too much margin. But it's too good of a play to pass up because look at all it's like a money machine. Nokia is still good for a new trade. Oh yeah. Because Nokia will expire in the money and be called away for 7,500. It's now 68.35. That's 9.7% in 30 days. That's normal. Those are the correct prices. That's just how options work. You know, we could actually do this all the time, but it's tedious. And the problem is, it's great when you're looking at something like Nokia and it's solid and it's not going to hurt us and so on and so forth. We have a 3-450 spread. It's at 623. We're not worried about that. We have the short 5 puts. We're not worried about that. It's not going to drop $1.23 in 30 days. So we're not worried about it. So we're almost certain to collect this extra 10% over the next 30 days. But if you keep doing trades like this, this will happen to you one day, and your loss can be pretty catastrophic. If it hits you at the wrong time, you can get a pretty catastrophic loss, and you don't have time to recover. Or if you get stopped out, it's even worse. So if you keep doing this all the time, even a good steady stock like this can burn you. In this case, we're now at a point with Nokia where we don't have any upside risk. We only have downside risk. So as long as it doesn't go all the way down here, we're fine. But it seems great when you look at it like this on a monthly basis, but you're only getting 10% a month, and a month like this can cost you 30%. So it works until it doesn't. And you have to be very careful and consistent to play those kind of things. It's like you don't want to make that your business, believe me. Because the more times you roll the dice, eventually you will come up snake eyes. Here's Ozark, and again, we're doing rolling short calls. Roll. I mean, we're rolling the short premium, and we're rolling 80. I mean, basically, we're rolling $8,300 to $8,500. So in other words, it didn't work this time, and now we're rolling it to another position that we hope is going to work in a few months. Meanwhile, there's $42,000, 128% upside potential. So, you know, there's no loss here. The only thing we lost is we didn't make money in this period. So this period, we didn't make money. We have 8 periods to sell. We didn't make money in this one. So what? Move on, sell the next period. That's your attitude on these things. Here's Pfizer. Same thing. So, you know, we have, here we expanded. We went to a bigger position on Pfizer. All right, because it's our trade of the year. So, you know, and I said, obviously good for a new trade. What I write here? Oh, people say, how can this portfolio make so much money? And I'm like, this is how it makes so much money. We just pick stocks that are extremely unlikely to go down, consistently selling short-term premium against them. If the stock, I just said this to you guys, If the stock is flat, we win. If the stock goes up, we win. If the stock doesn't go down too much, we win. If the stock goes down a lot, we're happy to buy more so we can win again later. You have to be really, really wrong to lose money on this system. You have to be really incredibly wrong to lose money. And if you use stops and get out of positions, you're not going to get hurt that badly. Here's Schlumberger. I mean, look, this is when you lose money, when this happens. Schlumberger went from 42 to 32. It dropped $10, 25%, all of a sudden for no particular reason. I don't know why. Well, actually, there was a reason. I guess they must have guided down. I bet they guided those earnings. But just because they guided those earnings doesn't mean it's a bad trade. And let's see, what did we do in April? Did we do anything in April? No, we own this for a long time. We own this. We didn't do anything. We own. Oh no, I'm sorry. We bought this recently. I'm looking. I was thinking like it's 24. No, we bought this recently, so it doesn't count. So whatever happened in April, we didn't care. And then came around. We had some short puts already from July. So here's what we did in July. There were earnings, and we said, "Oh, those aren't so bad. Let's sell some puts on Schlumberger." Then 3 months later, 4 months later, we decided, okay, you know what? These are performing okay. It's time to place a bet. And where did we place the bet? We didn't place it down here. We placed it here when it started to look like it was recovering, and lo and behold, it was recovering. SYF, our trade of the year. This is the third time we played it, so we've already made tons of money on this thing. And blah blah blah. And we made so much money on this one. So we had $54,000. We started with 36, but the point is that the net of the spread was 36 minus 9 is 26, minus 9 is 16. Minus 7 is 9. So we started off with net $9,000, and the way we protect the gains, and the gains are what? 17, 5, 6 is 28, 30. So the gains are 30. Oh, minus 4. All right, so call it 25. So you have $25,000 worth of gains. How do we protect it? We're cashing this whole position out. We're cashing the longs out, not the position. We're cashing out this winning $54,000. That's all the money we invested, plus another, plus the money we made, and we're taking $54,000 off the table. We didn't make $54,000. We made $25,000. But we're taking $54,000 off the table. We're leaving the short puts, which we're not worried about because they're at $83, and the short puts at 65 and 55. So that's just basically. We're back to basically a short put where we say, I'm happy to buy it. If it comes back to that price, we'll set up a new position. So there's no worries there. And the only exposure we have is the short 75 calls, right? The short 75 calls are currently $9,000, and we're kind of expecting them to expire worthless. Plus they're balanced by -4, -6 here. So -7 is the puts. Those are going to make us money if this thing gives us trouble, and vice versa. This will make us money if these give us trouble. And meanwhile, we're just selling premium, but we're selling premium without a backstop. But what's our backstop? $54,000 is our backstop. So why risk the $54,000 that's so many miles above what we thought this synchrony would be at? Right? Our shorts are $75 calls. So we thought it would get to 75. We didn't think it would get to 83. I think it's more likely it goes down than up. Therefore, cash out the longs, and $54,000 is now our backstop against any potential losses. But what's our risk? Again, we're balanced. These are short puts. Here's a short call. This expires in January. I think we rolled it. Yeah, then we roll this along, and we'll see what happens. So now we're just selling premium without worrying about having the position, because the position just made us $54,000. We don't usually do that. It's a little risky, but in this particular case, it's the logic is undeniable. Net $9,000. We're taking $54,000 out of the trade. Target. Well, you guys know I like Target. I've been talking about that every time it goes down. So this is good for a new trade, as I said. No reason we shouldn't. Oh, I see. So we had not covered it, but now that we've had this nice pop, I'm saying there's no reason that we shouldn't sell 7, 1/3. So in other words, 1/3 of the 20 spread. Sorry. So selling 1/3 of the 20 spread for $7. That's a lot of money. That's $4,900. And then we're going to balance that with some short puts, and we're generating cash, which is what we want to be doing. And the spread, look at the numbers. The spread was even here basically, and oh, I'm sorry, those are the puts. That wasn't even. So the spread was, we sold a ton of puts. That's what we did. We sold a huge amount of puts because I was so short. It was a stupid price. And so we took that money, and that wiped out the cost of our long calls, and then we sold some short calls. So we have a $20,000 credit on this thing, and it's a 30 times 20 is $60,000 spread. Oh, I guess all that math is here. So I'm just looking at it being like, that's a great spread. I can do the math. Now Whirlpool got knocked down because everybody's worried about tariffs and slowing consumer and blah, blah, blah. But to me, you know, you build a house, you got to put a washer and dryer and a refrigerator in it, right? And a stove, you know, those are all the things Whirlpool sells. Whirlpool also makes household appliances. Whirlpool is like 85% US made. Everybody freaks out about the tariffs, but they make everything they make. I don't mean assemble, they make their stuff in the US. They are very little tariff affected, and people don't understand that about their business. They're doing just fine. They just had a nice earnings report. They had a warning here because yes, they are affected by tariffs, but not to the extent people think, and they're trading like less than 10 times earnings at this level. So this is priced for a recession and no consumer demand and this and that. But an appliance is not a luxury item. You might cut back on appliances, but Whirlpool has lots of price points. You may cut back on appliances, but you still need the appliances. You don't see anybody saying, I'm not buying a washer and dryer for my new home. We're going to do our laundry by hand and save money. That's not a thing. And if that's not a thing, then therefore it's a necessity. So Whirlpool is a wonderful stock and ridiculously underpriced. And it has 1,300% upside potential, so definitely worth a look. And Exxon is going to have rocky times, but you know, Exxon is Exxon; they'll survive. And in fact, Exxon, because Exxon has the refinery and Exxon has the chemical business also, it's actually, when oil goes down, their other businesses make more money. So, you know, the spread increases, they're buying oil for less money and selling gasoline for a better spread. That's all good for them. So they'll work themselves out. We're happy with them, and that's a big upside. Well, not huge, but wait, no, that's not Exxon. Oh, that's right, the big upside potential. And by the way, what are we looking for here? Wait, roll out calls to the 100, 120. So we're in the 100, 120, and Exxon is currently at 115. So we have the 100, 120 spread, and Exxon's at 115, and we're drawing an income by selling short puts and calls. No wonder we make so much money. You see how this thing works? It's like, this is how you make money. This is the way you do it. So with the adjustments we made, mostly because we sold that SYF position, we added $89,000 to the $199,000 we had. So now we have almost $300,000 in cash. The upside potential is $426,000 of these positions as after being adjusted. And then we said, well, here's our final four. Then out of the last 10 that we talked about yesterday, 2 days ago now. So out of what we talked about yesterday, here's our final four: PPL, Micron, Pfizer, and Energy Transfer. And then we went through the trades on each of those. Energy Transfer. Now think about what I said about the infrastructure, right? Energy Transfer is a natural gas transfer. So it's really not about, they're not about the AI. They're about natural gas being exported from this country. It's the same drill baby drill mentality. We're building export terminals everywhere, but in this case, we do have an almost infinite amount. We're the Saudi Arabia of natural gas. We've got the most natural gas on the planet in this country, and Energy Transfer is the piping system that gets it from where it is to the shores where we send it overseas to an almost infinite demand for natural gas, because it's fairly clean energy, and liquefied natural gas makes it much more sensible to transport. In Europe, natural gas used to be a very localized thing. So even when Russia's supply was online, in Europe, natural gas would be like $10 per billion cubic feet. Our natural gas here locally was $2.50 or $2 per billion cubic feet. That kind of spread. Why? Because we didn't have a way to ship it overseas. When they have liquefied natural gas, you're compressing the gas 600 times. 600 times. So now it makes sense to ship it overseas. In fact, it cost about $1 per cubic foot to send, or per billion cubic feet, or whatever the hell it is. It cost $1 per whatever. That's the way to say it. $1 per whatever the hell they measure this thing in. So it's cost $1 to send natural gas overseas, and so if our cost here is $2, and it adds $1, and they're selling it for 10 in Europe, obviously there's a huge trade there. That's why they build these the export terminals. So now we're in this process of a 20-year build out of all these export terminals, and so they come online. But even though our supply comes online, but there's problems because it goes up and down, because our supply hits Europe and they're not ready. They don't have enough terminals to uncompress the gas, so on and so forth. But the whole thing will work itself out, and eventually the global supply. So what's going to happen? The European and Japanese markets, the supply, their prices of gas will come down because we're flooding their market with natural gas. Our prices will go up because we're no longer keeping our natural gas in the domestic market, and we're all going to even out. And the price I said we'd even out at 15 years ago is $4.50. So my prediction for natural gas is $4.50, and natural gas is currently, where is this stuff? Oh. Let me use this one. Ugh, index is not doing really well, are they? 405. So currently we're at 405. So my prediction is, and I'm talking long-term global, the overall real price of natural gas should be about $4.50, because it still doesn't cost us any more to extract it. We got all the, it's like Saudi Arabia. It's been $20 forever for them to pull oil out of the ground. That's their base cost, is about $20 a barrel. So that's why they can always control the supply of oil, because they got really cheap extraction costs. We have cheap extraction costs for natural gas. Cost us about $2. Cost another $1 to ship it over there. So the rest is just supply and demand dynamics on a global scale, because natural gas is now a global commodity, which it never used to be. So therefore, Energy Transfer, and this spread is net 3,500, and it's a 16.5 upside, so 471% upside potential, not including the sale of short puts and calls along the way. Micron, I'm sure you know Micron is the chip thing. In fact, Micron's going to have earnings after the bell. How's that for balls? We picked a stock that has earnings today. We picked the stock yesterday, has earnings today, as one of our 4 best trades of 2026. So We will see if we're right or not. But, oh, in fact, oh, geez, really? Oh, Phil. All right, we're so sure, and I'm so sure, this isn't Bodie making these picks, this is me. Bodie and I picked the stocks, but when it came down to the trade, that's my job. So oh, no, I see what I did. Oh, that's clever. Holy shit. All right. We didn't sell puts because we're allowing for the possibility that something might happen in the earnings. What we did is we bought the 200 calls in 2028. We sold the 250 calls in 2027, and we sold the 250 calls in March. So what we're doing is playing a time decay game. This is what we do in the $700 a month portfolio because we don't have any margin. And in this case, it's a very expensive stock, so we don't want to waste any margin capacity on it. So what we're doing is playing no margin. So we're paying $27,000, but we got that much. So we're paying $27,000. It's a $25,000 spread, but it only seems like a $25,000 spread because the 2028 $400 calls are $50. So in other words, we can roll this 58 and 25, right? We can roll this to a $200, $400 spread in 2028. And that would be a $100,000 spread. It only looks like a $25,000 spread now because we haven't allowed the time decay to work in our favor, but it will. It's just math. It will. Time will decay. The position will lose its premium. We will be able to sell more premium. We will make a boatload of money. So also a fantastic trade. I mean, obviously, if we can have an upside of $75,000 in the spread plus whatever we make selling short calls in a portfolio that's only $300,000, what's that going to do for us? And we're using no margin. We're just using $27,000 of our cash. That's brilliant. That is freaking brilliant. Holy cow. Anyway, now PPL we just talked about. It's hard to fill. Hopefully it'll fill. If it doesn't fill, it's no big deal. But if it does work out, we can net down to $600 and make $24,000. That's huge upside potential. But it may take a while to fill. And the trade of the year is Pfizer. Very easy to fill. Every single thing fills immediately when you do Pfizer. You might have to wait a bit for your price, but it's going to be generally good. And here in Pfizer, we had a $3,300 credit. Same concept. We're selling that premium, right? $3,300 credit on a $35,000 spread, $38,000 of upside potential because it's a 35 plus the credit. And that's 1,000% upside potential. But we also have 1,000% potential to sell premium along the way. So there's two major ways that we can have a 10 times win in a super steady stock, in a stock that looks like this. Here's $26, here's $21. That's the spread for the year. And if you go back further, where is that? Oh, look how good I am at presenting. It's amazing. If you go further back in time, this is where Pfizer's been since 2024 in this range. And even if you go back, well, it's not true. All right, so in the last couple of years, they've been pretty steady, and it's fine though. We don't care if they go up and down between 29 and 22. That's a reasonable range. We don't mind surfing that range, and it doesn't go that fast generally. We would mind if this happened, right? From 50 to 40 in a couple of months. That would be annoying. And then it goes from 40 to 30. That would be annoying. But we don't see that happening now because, first of all, their current PE is 14.7. Their forward PE is 8.3. So what's that telling you? First of all, it's telling you it's ridiculously underpriced. Second of all, it's telling you that their earnings are projected to go 50% higher next year. It's dropping the PE almost in half in a year. So even though they guided down and disappointed people with their recent forecast, it's still ridiculous how much money they're going to make. And you see what they're doing? They're buying not much, but they buy a little bit of their stock back on a regular basis. Who's got the most recent coverage? Price targets at 26, 30, 24. That's fine. It's just what we want, because I want to sell premium. We're going to make 1,000% selling puts and calls to people who think it's going to go out of the ranges. But if it doesn't go out of the ranges, we're going to make 1,000% while we're waiting to make another 1,000% on the stock going to 30 bucks or 32. What was the number? Oh, I love my job. I got to tell you. How satisfying is this stuff? 32. Yeah, 32 is that target. So we expect Pfizer to slowly but surely rise and head up towards 32 in a couple of years. And while we're waiting, we're going to sell puts and calls. And we just sold $5,500 of premium, right? And why do I say premium? Because we're at 25.19. So if we sold the 26 calls, they're out of the money. We sold the 25 puts, they're also out of the money. So that's 100% premium. And what for sure will happen in March of next year, what is absolutely going to be true, there will be no premium left on either strike. None. They can't possibly both lose. One will be in the money, one will not be in the money, or maybe they'll both be out of the money. If we're between 25 and 26, they'll both be out of the money. But either way, all of this premium, all $5,000 of premium is going to disappear. And that means that we have to be wrong by $2.50 to lose money. Otherwise, we will make money during this period. So we have a $5,000 buffer. So it could be as low as $22.50, or it could be as high as $28.50, and they're going to make money, and we'll make money. That's how these trades are constructed. And if we're wrong, and it's 29 or whatever, well, if it's 29, we're going to be thrilled because this money is going to be coming to us at 29. So 29 doesn't bother us. The only thing that really bothers us is going to be if this drops down to 22.50 or lower. Then we will lose a bit of money on the short puts. We won't be making any money here. And we'll have to think about, oh, were we wrong about Pfizer if it's down at 22.50? So that's our danger zone. We even know 3 months in advance where the problem would be. As long as 25 holds, it's happy days. Anything above 22.50 is happy days. That's a 10% below the current price. That's how this works. Our margin for error is gigantic. Our chance of winning is tremendous. This is how we construct our trades. This is the whole philosophy of what we do. And if you'll notice, none of these trades, nothing that we discussed here was a gamble. We're not taking outrageous chances. We're not picking crazy stocks, because we turn time into our advantage and we sell the premium, and all premium expires worthless. That's our whole house advantage. No matter what people bet, no matter what we sell them, all the premium will expire worthless. So these short-term people who buy options and pay premium, those are our customers. I was gonna say victims, but they are. I mean, they don't understand how to play it. And when you talk to people about options, and they say, I guarantee if you play options and you mentioned options to people, they've said, oh my God, how could you do that? That's the worst thing ever. I lost a fortune on options, blah, blah, blah. Nobody knows how to play it. Yeah, of course you're going to lose money if you don't do what we do. And we do the opposite of what everybody does. That's why we win. We're the house, they're the gamblers. All right, so hang on, let me just check if there's any more questions. Cody is asking, how do you set stops on the short puts in Thinkorswim? Just curious. Oh, it's easy. Just what I did before. Well, I didn't do it actually. I'm sorry. Here, you want to set a stop, you just do this, sell limit. You go to your option, you put your option in this thing, it'll show that you have a position, and then all you have to do is set a limit. If you want to do it that way, I don't advise it. I advise doing one just so you get an alert, you know, if you want to do it that way. But I don't like setting hard stops, because if you set hard stops, they will chase you and they will chase that hard stop. So I'm not a big fan of that. Oh, look at that. It went down to 55.77 and we didn't take it. That's okay. Like I said, I have conviction. I think this is going to be a very bad time for oil. And the dollar's coming back, so it's putting pressure back down on it. So I think that's good. Generally, I would take half off the table at 55.50. I would say I wouldn't even, oh, no, 55.50. We're not going to get there. I'm sorry. So maybe take half off at 55.75 and then set a stop at 55.85, something like that. Oh, look at that. That's cute. I didn't know that happened. Look at this side. If I do that, it comes up to the thing. I never did that. That's cool. Anyway, so those are your stops. But I don't like stops. I like mental stops, because the conditions can change. Like I said before about the dollar, I said don't pay attention to that, because the dollar was making it easy for oil to come up. So now the dollar is putting pressure on oil, so hopefully it'll start slipping even further. And I don't know if anybody's going to want to hold oil long into the weekend. We'll see what happens. But anyway, that's how everything works, and I hope you guys got something out of this. Oh my God, we're not going to. This is it. I'm going to miss you guys. We're not having a webinar next week because it's Christmas, and the next week is New Year's. So next time I see you all, it's going to be whatever year it's going to be, 2026. I'm telling you, I'm so burnt out. I got to get out of here. I need a vacation. Wow, January 7th. That seems like a faraway date. January 7th is going to be our next webinar. Oh shoot! Now I'm stuck with it. So January 7th is the next webinar, and all you guys have very, very happy holidays. Have a great New Year's Eve, and we will see you in 2026. All right, take care, folks.